Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
So today's video is going to be a little bit timely. We're going to be talking about war and more specifically how it affects or could affect your portfolio and what you shouldn't do when it comes to these uncertain times. And we're not just only going to be talking about I guess what's called now the 12-day war between Israel and Iran. We're going to have a much bigger history focused. So we've got a couple charts just dating all the way back 100 years ago, and you'll see that what happened over the course of the past couple weeks with Israel and Iran is not new. These conflicts or these larger scale wars have been going on for ever since the beginning of time, but it's something that at least the current market is it's not new to the market. And so we just wanted to talk about that and essentially help you pump the brakes if you ever start to panic when it comes to just how things are playing out, whether it's in the Middle East or somewhere else, and just to take a step back and to look at history rather than making a brash decision on the fly.
Yeah, well, I think we all hope that it stays just the 12-day war. It doesn't have to change its name or anything. But the first chart that we have here goes back to 1990 and 91. And I think that's kind of a timely period to look at because we had obviously Iraq invade Kuwait. We had some oil spikes. We had a lot of volatility in the equity market. And the only reason I bring this up because we have some similarities. So in 1990, we had a year going where the S&P was up on the year. If you look at the chart here, it was up 4.4%. The blue line that the chart is representing is that is oil prices. So in August of 1990, Iraq invades Kuwait. The S&P, of course, has a panic moment and is down 9.3%, while oil is spiking anywhere from right around, let's call it just under $20 a barrel up to just under $30 a barrel. So there's a lot of panic taking place. Not unlike what we saw, during this recent event, during this 12-day war. We did see oil spike. We saw some volatility in the equity market. However, it happened over the weekend. So we did see that be reflected in futures markets where the market was down quite a bit. Back to the chart here, as time goes on, you see oil continue to spike up to over $40 a barrel. The S&P, falls 16.4% on the year and down 20% from its peak. Now, if you think back to 2025, again, we had oil spike, not to the same magnitude back as the 90s, early 90s, but we had oil spike and we did have a 20% decline due to the tariffs, and all this happened in this quarter. Second quarter of 2025. But in 1990, we had oil double. So I think that's really, the kind of outlier here is oil went from, under 20 to 40 or so. That was 100% increase from July in 1990. Now, here's what I think we can learn from history. We see that the war continues. However, oil prices go down from about $40 a barrel down to down below 20, and that's February 24th, 1991. So oil is coming down quite a bit, let's call it 50%. You see the S&P 500 go up 24% from its trough, all while we have, Desert Storm taking place. Nothing is really calming down. We still have war escalating. However, oil's made this huge round trip. Equities have sold off and then have rebounded some. All all to the end of 1991, where the S&P actually ends up 13%. So it's a lot of volatility, a lot of drama, and the unfortunate part is war is taking place. So there's casualties there, but from a investment standpoint, people get all spun around and kind of get off track, all to end up, maybe in a similar place, if not the equity side, it was up 13%. So just wanted to bring that comparison to what's taking place today, because of course nobody knows the outcome of this whole Iran and Israel situation. We hope that things calm down, but we've already seen just this week. We're filming this on Thursday, and equities were down big over the weekend. We came into the week. There's potential for a ceasefire agreement. We hope that holds. Thursday here, there's markets that are hitting all-time highs, and some of this is behind us. So if you would have came into the week and kind of repositioned everything to kind of go extra long oil and all the defense companies, that maybe have been the wrong move, when now we have technology and the S&P right back to near record highs.
Yeah, it's funny looking at this chart, because when you look at it just without looking at the specific dates and whatnot, it looks like it could be a chart over the course of the whole 90s. And in reality, it's really highlighting, like you said, a year and a half. And that's a lot of activity to happen within a year and a half. And, if you had done what you had said, or you sold everything off, or you positioned yourself to have more of oil or more commodities in that sense, you would have lost out on that, especially if it was more oil positioned. And this is all in a short period of time. And it's
relatively very short.
Yeah, and it's even I think today the markets whiplash a lot quicker than 20 years ago or 30 years ago, because we're so bombarded with headlines that we get the news, or any little potential thing happening, we get that instantly.
Yeah.
And the markets react to that. And of course, a lot of times it could be a overreaction, and then it ends up calming down quite a bit once things kind of have fizzled out.
Well, that tends to be the case. I think it's no argument that markets are moving quicker than ever. Like you say, we get things instantly. Prices are adjusting a lot quicker. So when news comes out that it's maybe not as bad as we had thought, the markets rebound quicker too. So it's like, if you're chasing that, you just, I don't even know, you come out of it just being like, what in the world just happened? Because it just is a whiplash.
Yeah. We have another chart here. Let me pull this one up. This one's from a fund company called First Trust. I think we've shown some of their charts in the past before. This one specifically highlights war, or times of war, in just the stock market. And it goes up to 22 with when Russia and Ukraine started happening. But you can see over the past 100 years, wars and conflicts and regional conflicts, it's nothing new. And in fact, I don't think there's been a period of time where for at least 10 years there hasn't been any type of conflict or war. So it's nothing new. And even if you go back, this is what we were talking about, the Gulf War. Market dip, that's probably what Dustin was mentioning there, and then eventually rebounded. And it kept on rebounding. And then obviously we had the dot-com bubble. This is when the Afghanistan, or excuse me, the Iraq war happened, and from there, market still went up. So
no, go ahead. Sorry.
Well, I was just going to say it's good not to make these rash decisions when it comes to these big, large scale conflicts that are brewing wherever the case is. Just because, at least looking at history, the market always tends to kind of balance itself out and rebound.
Well, and something to mention too, I think it can be hard to see the bigger picture when we're in times like the chart you're showing. I mean, think of what we're being bombarded with that entire time. It's news headlines and nonstop on TV, just like this recent one. It's World War III. Everybody was over the weekend was saying World War III is coming, and go get in your bunker or whatever if you have one. But it's very hard for an individual to not get some type of panic, and the media helps spin this narrative and spin you up that really can get you off track. And you kind of come out the other side if you can ignore some of it. It's good to be informed, but maybe not take action on every headline. You're so much better off because, I mean, literally this 1 week is almost night and day from where we started to where we ended. And who would have thought that?
Yeah.
It's impossible to predict. You just
Yeah.
can't be chasing things around like that.
There's another slide here. This one's interesting. So this one goes back to 1970. So from 1970, if you had $10,000 and just invested it into an S&P 500 index, again, this shows all the conflicts happening and even other stuff too, like Black Monday, and just things like that. But even so, by now it would be, or by 22 at least, probably more now, but it'd be worth 2.1 million.
Yeah.
And let's say you started in 70 and then all the way up to, let's see if I can find it. When we invade Iraq, that's at the time was worth, let's just say 200,000. And let's just say you just put it in cash or just kind of put it in something safe. Well, you would have missed out on this huge run. Of course, we had the 08, 09 crisis, but again, you would have missed out on another huge run too.
Well, what's interesting about that chart, Jay, is the thing that jumps out to me is how many events are on there. They almost can't even fit them all
I
on
know.
that page. So if you're always waiting for that perfect time where there's nothing going on to invest, I mean, you're never going to be invested. That's why there's that saying, the market climbs the wall of worry. It's true. It's there, when there's all these people saying that this is, you need to be in safety, you need to be in cash, you need to do this and that, and kind of protect yourself. When there's enough people saying that, the market tends to kind of just grind higher and higher and higher, and eventually drags those people into and really makes a high. So it's just
Yeah.
better to have a nice diversified portfolio of good quality companies. Maybe have some alternatives in there if that's how you'd like to build your portfolio, and just kind of ride out some of these times and ultimately not make a irrational decision on a headline that we don't know the outcome of.
Yeah. And then the other problem too is, okay, when do you get back in?
Yeah. Well,
Yeah.
if you would have done it this week, you would have been out on Monday and back in at a higher. So, of
Yeah.
course, we don't know what tomorrow brings, but
It's always,
you know,
it seems like it's always a lose-lose situation. And there's people that can do it, but it's not a common thing, at least from our
no,
experience.
no, it's really not. That's what people make it seem like that you can do that on TV or on Reddit, but I don't think it's as common as they make it.
Exactly. Yeah.
Well, we hope you found these charts and our commentary on the week's events useful. Definitely was a busy week. We look forward to bringing you more content next week. If you did like it, please like, subscribe. We'll see you in the next video.